In this video, I'll provide a review of the Bank of America stock and what I look for when evaluating potential dividend stock purchases. In the first section of the video, I'll run through what the company does and how they make money. Then I'll look at some of the numbers and metrics that I find useful in evaluating companies, as well as looking at the dividend history and also the company's revenue, net income and cash flow. And finally, I'll offer my own individual thoughts and opinions on the stock. So, who are the Bank of America? Regarded as one of the world's leading financial institutions, the Bank of America serves individual consumers, small and middle market businesses, and large corporations with a full range of banking, investing, asset management, and other financial and risk management services. The Bank of America operates four main business segments: consumer banking, global wealth and investment management, global banking, and global markets. So let's briefly take a look at each segment in a little more detail. The consumer banking segment offers traditional savings accounts, investment accounts and products, credit and debit cards, residential mortgages, and direct and indirect loans. Global wealth and investment management provides comprehensive wealth management to high net worth clients. Clients are served by teams of advisors offering a range of financial products and services, including investment management, financial planning, specialty asset management, custom credit solutions, and financial administration. The global banking segment provides lending products and services, including commercial loans, leases, trade finance, and commercial real estate and asset-based lending. It also offers treasury solutions, such as treasury management, foreign exchange, and short-term investing options. Global banking also offers working capital management solutions, debt and equity underwriting, and merger-related and other advisory services. Within global banking, clients generally include large global corporations and financial institutions. Global markets offers trading and research services to institutional clients across fixed income, credit, currency, commodity, and equity businesses. Global markets products include securities and derivative products in both the primary and secondary markets. This is basically the investment banking segment of the bank. So those are the four business segments, and the Bank of America make money through those areas via service charges and fees. For example, monthly account fees, overdraft fees, minimum balance fees, transaction fees, etc., etc. The bank also receives money from interest they earn by lending out money to other customers and clients. Banks will basically lend their money out to customers as overdrafts, loans, mortgages, and other products, and the customer will then pay interest back to the bank on these borrowings. At the end of the first quarter of 2021, the Bank of America served approximately 66 million consumer and small business clients with around 4,300 retail financial centers, around 17,000 ATMs, and around 40 million active users across digital banking platforms. Let's now take a look through the numbers and metrics that I find useful in evaluating stocks. The Bank of America has a current dividend yield of 2.01%. Last year's dividend yield averaged at 1.72%, so it's a positive sign for dividend investors that the yield has increased. It just means that we're able to purchase discounted income and receive more value for our investments. Over the last 5 years, the highest dividend yield was 3.82% in March 2020, and the lowest was 1.01% in February 2017. And the average yield over this period was 1.85%. So it's good for me that the current yield is higher than the average yield over the last 5 years. In fact, the Bank of America have increased their dividend consecutively for 8 years, and we'll take a more in-depth look at the dividends later on in the video. Over the past 5 years, the average dividend per share growth rate was 31.70% per year. So there has been a very rapid growth in the dividend over the short term, but I don't expect this to continue at this rate into the future, as this would be very unsustainable. The payout ratio is currently 24%. This just shows the proportion of earnings a company pays shareholders in dividends, and is expressed as a percentage of the company's net income. With payout ratios, obviously the lower the percentage the better, and I tend to consider around 80% as being a high ratio. So for the Bank of America to have a ratio of 24% is incredible, and strikes a good balance between paying dividends and keeping enough capital back to reinvest into growing the business. Also, if reinvestment opportunities do dry up, the company has room to increase the dividend. If we have a look at the last 10 years of the payout ratio, we see that this number is typical of the company. We did see a negative payout ratio in 2010, as the net income was negative as the company made a loss. There was also a 120% ratio in 2011. This was because the company posted a $3.2 billion goodwill impairment charge, which would have reduced the net income. An impairment is basically an accounting treatment where a company reduces the value of an asset that it considers damaged, unusable, or worth less. So, in this instance, looking at the company's investor presentations, we can see that the Bank of America decided that their European consumer card business isn't as valuable as previously thought. So they've just reduced this value down on the balance sheet by $581 million to reflect this. And without getting too bogged down in the detail, the remaining $2.6 billion comes from a goodwill reduction from the gain on the sale of Balboa Insurance in 2011. So if we exclude those irregular years, the average payout ratio is 31%, which again is very pleasing to see for a dividend investor. The market cap of the Bank of America is $347 billion US, which classifies it as a mega cap company. This is a company with a market cap over $200 billion US. I do like these large blue chip companies in my dividend portfolio, as they tend to be mature, secure organizations, and the dividends tend to be more reliable than smaller cap companies or new startups. The Bank of America has a share price of $41.05, which puts it in the top end of the 52-week price range. The 52-week low price of $22.95 happened in September 2020, and the stock has seen a very good recovery since then, nearly doubling in price. The current price looks fairly reasonable to me right now, especially when you compare it to the 50-day average of $39.82 and the 200-day average of $39.67. So now let's look at the dividend history of the company. You can see that after the financial crisis of 2008, the Bank of America drastically reduced their dividend. Prior to 2008, the Bank of America had a dividend yield of between 3 to 5%. The banking giant was historically a great choice for dividend investors, but all that changed in 2009 when the bank was forced to cut its dividend in order to comply with government restrictions after taking TARP bailout funds. This is a troubled asset relief program designed to keep the nation's banks operating during the 2008 financial crisis. So in 2009, after the cut, the Bank of America's quarterly dividend was just 1 cent per share. This left investors with a 0.23% dividend yield. We can see that since then, the dividend trajectory is definitely looking upwards, moving from 4 cents a share in 2009 to 72 cents in 2020. However, this is still a long way from the $2.24 being paid out prior to 2008. Let's now have a look at the chart showing the Bank of America's revenue, cash flow, and net income. It is useful to look at the dividend history, but we also need to look at the company's earning potential and trends, as the revenue and profits of the company will drive future dividend increases. So we can see a nice steady revenue line, which was slowly increasing before COVID struck in 2020 and pushed the line back down. It's worth noting though that these numbers are incredibly large, ranging from $74 billion at the lowest point to $88 billion at its highest. I like that the net income line follows the revenue line quite closely, which just shows that the management have the costs under control. To evaluate this further, we can look at the profit margin, which is just the net income divided by the revenue. This is useful to me as it shows how good the management are at controlling their costs and therefore ensuring that the business is profitable. The profit margin is currently around 25%, and this is slightly above the average of 23% over the last 5 years, which is good to see. A good margin will vary considerably by industry and size of business, but as a general rule of thumb, a 10% net profit margin is considered average, a 20% margin is considered good, and a 5% margin is considered low. Cash flow does look very erratic at first glance, with huge inflows in the $60 billion range, but also a few large outflows in the $11 billion range. Oddly, the negative cash flows are not necessarily bad, because they indicate that the Bank of America is devoting its money to financing, which is a bank's primary activity. The thing to remember about a bank's cash flow is that when a bank lends out money, its cash flow will naturally decrease. Once the customer pays that cash back to them, they would expect to recoup more than they loaned out. In my opinion, this is positive, as it shows the bank is investing for the future by lending this cash out. And looking further into the end-of-year cash-in-hand balances over the last 10 years, we can see a very healthy position, with $890 billion in the bank last year and an average of $600 billion over this period. So, the Bank of America has a lot of cash in reserve should it need it. So, what is my opinion on the Bank of America? For me, the sheer size of the company makes it very appealing as a financial sector dividend stock. It's dull, it's boring, and I'd imagine that most YouTubers and influencers won't be talking about it much, which is exactly why I like it. It's steady, it's reliable, it's dependable. It's a bank with a strong customer base, abundant and rising deposits, is a market leader amongst major retail banks, and boasts excellent management. Few industries are more heavily regulated than banking, especially after the 2008 financial crisis threatened to collapse the US banking industry altogether. Nowadays, banks are required to maintain minimum capital levels, which is set by the Federal Reserve. The Federal Reserve can change this level depending on how the overall economy is performing. For example, they'll increase the minimum level when too much is being lent out, and reduce this during an economic downturn to encourage customer lending. Some larger institutions are required to submit to stress testing to determine their ability to survive in adverse economic environments. This helps to lower the risk associated with bank stock investing. It's because of this more stringent regulation that banks are much better prepared for a recession or economic downturn than they used to be. For me, investing in the Bank of America will always be part of a solid, long-term core portfolio holding. I currently hold 19 shares of the Bank of America. I feel this is a good position for me relative to my overall portfolio, so I haven't added to this for a while. But it's a company that I like, and I will continue to purchase shares in the future. Remember that this isn't investment advice, and you should always do your own research and due diligence before making any share purchases. I hope that you've enjoyed this stock review and taken some value from it. If you have, then please like the video and subscribe to the channel to make sure that you don't miss any future videos. Also, please let me know what stocks you'd like me to review in the comments section below. Thanks again for watching, and I'll see you in the next video.